You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. If you've been keeping an eye on things this week, you'll know the global market opened with a really tentative feel.
Tentative is definitely the word. Yeah.
It feels like we're caught between these conflicting signals, you know? The dollar eases off a bit, but then you see gold just surging to record highs.
Exactly.
So our mission today is to try and cut through some of that noise. We've got a pretty comprehensive briefing covering FX, central bank talk, commodities, and that rapidly heating U.S.-China trade situation.
Right.
We need to find the connections, figure out why the market's moving the way it is.
And that tentative tone you mentioned, it tells us investors aren't exactly panicking, but they're certainly not relaxed either. What's really interesting is how the underlying tension hasn't gone away. It's just changed shape. Trade tensions are still, the big macro story weaving through almost everything.
Okay.
Washington might have tried a slightly softer line over the weekend, maybe hoping to calm things down a bit.
Yeah, maybe less headline risk.
But Beijing's response was immediate. They announced fresh, quite specific countermeasures.
So softer words from one side met with hard actions from the other. That tension must be why we're seeing these key moves right now.
I think so. You see the dollar index easing back slightly after its run-up.
Right.
Spot gold just keeps climbing. That historic surge continues. And crude oil is, importantly, holding on to its recent gains.
Okay. Holding gains in oil. That suggests something about demand.
It does. It suggests there's still real conviction about underlying demand, even with all the geopolitical noise swirling around.
Got it. Okay, let's dig into where macro policy really bites. Foreign exchange. The dollar index is softer, like you said, but it's not exactly collapsing. Feels anchored somehow.
It does feel anchored.
What's providing that stability?
Well, the anchor, especially for the short-term rates, really came from Philadelphia Fed President Paulson. He gave some pretty clear guidance.
Okay.
He backed a gradual path for rate cuts spread over the rest of this year and into next. And crucially, he described current policy as modestly restrictive.
Modestly restrictive. Why that specific phrase? What's the signal there?
It's quite deliberate, I think. If they just said neutral, the market might price in much faster cuts, to boost growth.
Right, get ahead of it.
But by calling it modestly restrictive, Paulson's saying two things. First, they think policy is tight enough to keep working on inflation. Second, they have room to wait, to watch the data come in.
Okay, so it manages expectations.
Exactly. It limits how much the dollar might drop just based on rate cut hopes alone. It means the dollar stays really sensitive to any surprise data, and of course those trade headlines we keep mentioning.
So if the dollar's anchored, let's look across the pond. The euro's grinding higher, trying to push up towards, the mid to high 1.15s?
Yeah, it's making a bit of headway.
Is that just dollar weakness, or is there something happening in Europe itself?
Well, dollar weakness certainly helps, but there's definitely a shift in focus towards European factors too. Politics, fiscal stuff. People are watching incoming survey data very closely, and particularly the budget situation brewing in France. We'll come back to that.
Okay. And sterling?
Sterling's holding fairly steady for now. Everyone's waiting for the next big UK labor figures. That'll be key for the Bank of England's thinking.
Right. Speaking of data, there's another one coming up that could sway sentiment in Europe, isn't there?
Absolutely. We've got the German ZEW Economic Sentiment Survey coming out.
Remind us what that measures?
It basically gauges the mood among institutional investors and analysts about Germany's economic outlook for the next 6 months. So it's a kind of forward-looking confidence indicator for the Eurozone's biggest economy.
And if that disappoints?
Then the story could quickly shift back towards worries about European growth, kind of regardless of what the dollar's up to.
Okay, got it. Let's head over to Asia. The yen firmed up. That usually means risk appetite is cooling off, right?
That's the textbook reaction, yeah. And it played out just like that. The yen gained as risk sentiment generally soured late in the Asian session.
Any specific trigger?
Partly prompted by Japanese officials repeating their usual lines about wanting orderly currency moves. That tends to make speculators a bit nervous.
Okay. But interestingly, the Aussie and Kiwi dollars, the AUD and NZD, they lagged behind, even though the RBA news sounded pretty okay.
Yeah, the RBA minutes came out basically saying no rush to cut rates, policy stays cautious and data dependent. That's positive locally, suggests they're staying tight.
So why didn't they rally?
It was really about the bigger picture, the weaker global risk tone. That general caution just overshadowed the positive local signals, keeping the AUD and NZD down.
Risk off Trump's local news. Before we leave FX, quick word on Singapore. They have that unique NOR system.
Right. The Monetary Authority of Singapore, the MAS, they left their SGD near settings unchanged. Just to remind everyone, they manage the Singapore dollar against a basket of currencies, not interest rates.
And the outlook?
They basically confirmed a steady approach. They see core inflation bottoming out soon, then gradually rising into 2026. So it really ties the Singapore dollar's fate to that regional risk picture. Global sentiment is driving things there too.
Okay, so central banks setting the boundaries, global risk pushing the direction. If risk is key in FX, then commodities must be where we see that uncertainty really clearly. Let's talk gold. It's not just rising, it's smashing records, past USD 4,150 an ounce.
Yeah, it's quite spectacular. When gold breaks through big round numbers and technical levels like this, it's more than just traders jumping in. It's pure structural haven demand kicking in.
And the driver is?
It's that convergence we talked about, ongoing trade uncertainty, plus geopolitical risks simmering away.
Right.
You look at the supply chain issues we're about to discuss, add in the tensions in the Middle East, Eastern Europe. Capital looks for safety, somewhere governments can't just print more of, somewhere crises don't easily destroy.
Okay, pure haven. Now, contrast that with crude oil. You said it's holding its gains. That suggests a different story underneath.
It does, yeah. It points to resilience in demand. And we got 2 bits of data supporting that this week.
Oh, yeah.
First, OPEC's latest market report. They left their demand growth forecasts for 2025 and 2026 completely unchanged from last month. They're still optimistic.
No cutbacks there.
And second, Saudi Aramco, probably the best single indicator of global energy demand. They stressed that consumption is still strong. They even specifically said they can keep pumping 12 million barrels a day for up to a year without more investment.
Wow, that's a strong signal.
It really is. It says, despite the trade wars and the political noise, the world still needs a lot of oil right now. Physical demand is firm.
Okay. And what about industrial metals? They had a good run earlier in the week, but seemed to cool off.
They did, yeah. They stepped back from Monday's highs as that sort of overnight risk-off mood settled in a bit.
But the bigger picture for them?
The key thing for industrial metals, really, their whole story still hinges on China. Everything.
Demand from China.
Yeah. Partly demand, yes. Infrastructure spending, manufacturing. But now, crucially, it's also about any potential supply chain problems linked to Beijing's administrative actions. New export controls, shipping measures. It all filters back to the U.S.-China dynamic.
That brings us neatly to the core tension, doesn't it? Section 3. This U.S.-China dynamic that seems to be setting the whole market tone.
Yeah.
You mentioned the paradox. Washington sounded a bit softer, but Beijing came back hard.
Yeah, that aggressive stance from Beijing is really the main headline today. China's Ministry of Commerce put it very bluntly. The U.S. cannot have talks while threatening new restrictions.
So preconditions.
Essentially, yeah.
Yeah.
They're saying Washington needs to fix what Beijing calls its wrong practices before serious talks can happen. And critically, this wasn't just talk. It came with specific, concrete actions. So this feels like a new phase.
Okay, let's get into those actions, because it sounds like they're using more sophisticated tools now, not just blunt tariffs. What exactly did Beijing do?
That's right. They signaled they're ready to use their regulatory and administrative muscle. They detailed 3 specific countermeasures.
Okay, what are they?
First, targeted actions against 5 specific U.S.-linked firms. Very precise.
Right.
Second, they started putting special port fees on U.S. vessels. That hits logistics and shipping costs directly.
Ooh, okay.
And third, this one is really strategic. They've opened a regulatory investigation into how the U.S. Section 301 tariffs have impacted China's own shipping industry.
Hold on. That Section 301 investigation, just remind us what those tariffs are.
Sure. Section 301 is part of U.S. trade law that lets the USTR investigate and hit back against foreign trade practices the U.S. sees as unfair. These are the main tariffs the U.S. put on China going back several years now.
Okay. So by investigating the impact on their own shipping, What's the goal there?
Well, it looks like they're building a legal and regulatory case for future countermeasures. Countermeasures aimed not just at goods anymore, but potentially at the whole logistics network that moves those goods.
That really does shift the battleground, doesn't it? From factories to the ports and seas.
Well, could, yeah.
I also saw they mentioned rare earths. Officials stressed it's a license system, not a total ban. Why make that distinction clear?
That's crucial. The difference between sparking an immediate full-blown crisis with a blanket ban.
Right. Which would cause global panic.
Exactly.
Yeah.
Versus sending a very clear but calibrated threat. By emphasizing licensing, they're saying we control the tap. They can adjust the flow using these administrative tools, the licenses, the port fees, the investigations based on what the U.S. does.
So it's like having a dimmer switch instead of just an on-off switch.
That's a great analogy. It's an ongoing, adjustable way to exert pressure.
So if Beijing is getting ready to use licenses, fees, probes as strategic weapons, what does this mean for how markets price risk?
It means the risk of these small incremental frictions stays high, constantly simmering, especially in sensitive sectors like semiconductor, shipping, strategic minerals. And these frictions then feed into FX and commodity prices, not through one big shock, but through these complex channels affecting growth forecasts and terms of trade. It's a much more nuanced, persistent threat investors have to grapple with now, not just waiting for the next big tariff headline.
Okay, let's zoom out again for a moment. Geopolitics. We need to touch on Europe, since the euro's fate is always tied up with politics and fiscal health there.
Yeah, definitely. Over the Middle East, the focus is still very much on getting that Gaza framework implemented. The plan involving hostage prisoner swaps alongside troop movements.
How's that playing out?
Well, statements from different players are still trying to manage expectations about the timing and how it'll be enforced. For energy markets, the main point is, even though there's a diplomatic process, that headline risk is still very much alive.
Meaning?
Meaning any hitch in the plan, any sudden change on the ground could still easily cause an oil price spike.
Right, fragility remains. Back in the Eurozone, you mentioned French politics earlier impacting the euro. What's this budget milestone we need to watch in Paris?
Paris is about to present a really important budget plan. The goal is to cut the French deficit down to 4.7% by the end of 2026.
That sounds ambitious. Why is it such a big deal beyond France?
Well, it's more than just French domestic policy. It's seen as a key test for the whole Eurozone, really. The market's nervous because hitting that target means making some politically tough spending cuts.
And if they don't manage it? Or if the plan isn't credible?
Then it could trigger a wider, pretty uncomfortable discussion across the Eurozone about debt levels, especially after all the pandemic spending. France is a core economy, so if they stumble on fiscal discipline, it casts a shadow. It definitely impacts Euro sentiment and those broader fiscal debates across the bloc. Adds to the jitters.
Understood. And lastly, Ukraine. That risk never seems to fully go away, especially for gas markets.
No, it doesn't. Kyiv reported more strikes on energy infrastructure just this week, and they signaled they're going to keep pushing allies hard for more air defense and clarity on getting longer-range weapons.
Here's the impact.
It just keeps that Eastern European risk premium ticking higher, and it means European gas markets have to stay constantly vigilant, especially as we head into higher demand seasons. Any disruption there is felt immediately across the continent.
Okay, so we've covered a lot. The anchor dollar, gold's haven flight, Beijing's calibrated pushback. Can you give us the final synthesis? We have data points coming up, UK labor, German ZEW, but where's the market's main focus, its overall tone, coming from right now?
Yeah, look, those data points will definitely cause some bumps, some volatility intraday. But the underlying tone, the mood music, is still being set overwhelmingly by that U.S.-China trade narrative, specifically this new phase of administrative friction.
And the market reaction reflects that.
I think so. It's strong enough to really move prices. I mean, look at gold. But there's still so much uncertainty that it keeps that haven demand alive and well. We're kind of stuck in this holding pattern, defined by this increasingly sophisticated friction.
That sophistication seems key. So the things to watch closely are the dollar's drift, gold's momentum, and any new moves from Washington or Beijing on tariffs, but especially on those administrative costs or controls, the port fees, the licensing.
Exactly. It's that shift in tactics that changes the game. Traditionally, trade fights were about big, blunt tools, huge tariffs everyone could see, public bans.
Right, easy to track.
Now we're seeing governments getting much better at calibrating these administrative levers, specific license rules, regulatory probes that just inject uncertainty, targeted fees that don't always make the front page.
That subtlety raises a really interesting question, maybe something for you, our listener, to think about after this. What's the real long-term impact on global supply chains when governments start relying on this kind of nuanced administrative pressure instead of just big public bans to achieve their strategic goals?
It's a huge question. It means the risk is harder to quantify, definitely harder for companies to hedge against, and it could be much more disruptive to very specific, sensitive parts of the supply chain. It forces businesses to spend fortunes navigating complex regulations, not just finding alternative suppliers.
That underlying strategic uncertainty, that's what we all need to keep tracking. Thank you for joining us for this deep dive today.
My pleasure. Always good to talk it through.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.